I think specifically in this part of the world, one will be monitoring how China responds, not just to policy measures, but also this is exogenous shock in due course, especially, Johanna, given the fact that we have the 2 sessions coming up.
No, absolutely. I mean, China wanted stability. That was the big mantra into this year. And the last thing they want is another geopolitical risk. So I think right now, I mean, going into MPC, we haven't really made any major changes to our expectation. I think they will continue to emphasize the need for growth and stability. So a lot of our forecast and anticipation of targeting above 5% growth, targeting central government deficit of 3.2, but then allowing a larger special local bond issuance of 3.8 trillion. That's kind of pretty much in line with what a lot of people are expecting. I think on the monetary policy front, we certainly think that there's still room for PBOC to ease. We don't think this potential additional inflation risk is serious enough to deter PBOC, especially in a backdrop where growth is a concern for China. And also from the backdrop that actually in this entire risk-off event, the renminbi has actually been fairly stable. And if that persists to be the case, then that actually gives a little bit more leeway for PBOC to actually ease further. So we still have, I think for the monetary policy front, I think the bias will still be to be flexible and moderate, and they probably will continue to emphasize maintaining liquidity to be ample. But I think there is room there to ease further, even in the backdrop where inflation is higher and the Fed is going to be hiking even more.
Ease further, ease how?
Sorry?
I mean, what sort of tools do you think they would resort to in terms of those easing measures?
Yeah, so China, I think there's a little bit more room on monetary policy. So we still have 25 basis points on the benchmark rate cuts. We still have 50 basis points triple R cut. But the reality is I think a lot of the heavy lifting has to be really done by fiscal policy. And they'll try to stabilize the real estate market. But having said that, I mean, the hole left by the real estate is too large that the only thing they can partially offset that hole is a little bit more infrastructure investment. So I think that's our assumption. Even though we think they're going to target above 5% growth, the reality is it's going to be very challenging. And, we are still forecasting below that. We're forecasting 4.7% growth.